Yeah.
Hi everybody, Dave Rauch here, CEO of ProTech Building Services, and welcome to the Maintenance Manager. Today I have with us Cory Neubauer. Am I saying
Neubauer, yeah.
Neubauer. Say it for us.
Cory Neubauer with NEXTIER Insurance.
Neubauer. So I did have it right.
You got it.
All right. Well, welcome Cory, and thanks for being here. And Cory's going to tell us a lot about California insurance. And one of my questions is California insurance similar to what's going on nationally, or is it unique?
It's a good question, right? I think the best way to frame that is maybe think of Florida, right?
Mm-hmm.
Do we see Florida as a unique situation, right? With the catastrophes and stuff they had, you can kind of see some foreshadowing taking place. So obviously in California, we're having a lot of wildfires. We unfortunately just had that devastating wildfire. I think there were over 12,000 structures that were damaged or completely lost. So there's a huge loss that's coming. So we do have quite a few different things that are impacting the insurance market in California.
Right.
I mean, obviously it's the natural disasters that are coming. They seem to be happening more often, right? And they're a lot more severe. So all that's taken into place along with, we've had record inflation. You and I were talking before this of, insurance costs, labor costs, everything is going up.
Yep.
So insurance is to rebuild once you have a loss. So that cost to rebuild has gone way up.
Right.
So yes, what's unique in California from that perspective of we're kind of hitting the perfect storm between reconstruction costs, increasing natural disasters, and just the makeup of what we have.
And from what I've read, I think the fires in LA are going to cost the insurance industry $30 billion, maybe $50 billion, and so that's going to be a big hit. And when do you think that might hit?
So that's a good question. We just saw last week that the California Fair Plan, which is the plan of last resort, they're going to be taxing the admitted carriers about $1 billion already. So we see $1 billion coming through on that, and we're going to continue to see that. State Farm just also tried to raise their rates, so we're about 20% on average. And those weren't approved by the insurance commissioner. They want more information. So we're going to see a huge loss. I mean, you say 30, 50 billion. Like I've seen numbers gone up to over 200 billion because of the infrastructure that has to be replaced, right? All those were electrical lines above ground. Like they're not just going to rebuild this exactly the same way, right? There's a lot of building ordinances that have to be upgraded. So you think of all those situations. We just finished a lunch.
So much fun.
We just finished a lunch and learn, and we were talking about the Maui fires. They're saying that's 4 or 5 billion. So if you're talking even 30, we're talking more like 100 or 200 billion. Just the magnitude of that loss is so huge. So it's kind of hard to tell, but it will impact it. Underwriting right now is a lot more strict. So the carriers are already starting to look at things in a more scrutinizing way of what risks they're going to take. So you might not see the increases immediate, but they're going to be a lot more stringent on what they're willing to insure.
Gotcha. Before we get too far into our conversation, Cory, tell us a little bit about Cory and about your company, your insurance company.
Perfect. No, I appreciate that.
If you don't mind.
Yeah, so we're NEXTIER Insurance. So we're an independent insurance broker, and we focus specifically on HOAs. And I'm glad that we had a chance to talk because I like what you do. And I think getting education and getting information out is important. And I think in this space, there's a lot to learn. And we have some really good people in our industry. So for us, we started this a couple years ago. We came out of a captive insurance agency that was been in this space for many, many years. So we have team members, I think we have over 50 years of combined experience. So we understand the HOA space and we understand what it takes, and it's getting more and more complex.
And you serve all of California or beyond California?
We do California, Arizona, Nevada. We can go in further areas, but right now the main focus is California, and there's a lot of HOAs that need a lot of help.
Gotcha. And your clients are all HOAs or primarily HOAs?
We just specifically focus on HOAs. We have a lot of other great referral partners for personal lines, for homeowners, for medical, whatever it is you need, we can get you to the right people, but we want to stay focused, much like you, right? You're not doing large construction projects, you're staying right in your core competency, and we want to do that, and we see that there's still a lot that needs to be done.
Great. And quick question for you. You mentioned captive.
Yes.
I've always been captivated by that term.
Yes.
What exactly, in a simple layman's terms, does a captive mean?
So the simplest way I try to explain it is think of Apple. Apple products.
Apple products.
If you're in the Apple ecosystem, you have to stay in the Apple ecosystem, right?
Okay.
All your computers talk to each other in the same fashion. You're on iTunes, you're on whatever that is. That's the best way to say in the sense of captive. And if it's Android or these other things, it's open or it's non-captive, so they can go out to multiple markets. So really for us, explaining that is really they have the ability to just sell in one product.
Okay.
And I'm not explaining it. I'm not explaining it well by your thing.
That's
so
fine.
It is a kind of a complicated situation, but it's captive or admitted or non-admitted.
But it has to do with the carriers and
of what carriers
they sell from.
Who they have access to. So as an independent, you have access to multiple carriers.
Okay, thank you for that.
Yes.
And so let's go back to the California versus U.S. insurance markets, because I'm very curious about that. From what I've read, insurance costs have gone up for the average HOA, and I think this is throughout the nation, of 20%. However, if you're in a fire zone, which I would imagine that's mostly California, but I guess it could be other states too, your insurance costs could have gone up 100, 500, 1,000%. So is that true? Insurance costs have gone up nationally 20%?
That's probably a safe assessment. We are in a kind of a microcosm here and experiencing those large increases. And that's really happening because now we're going to talk about captive, we're going to talk about admitted and non-admitted. Okay. And admitted carriers are those state farms, those farmers. They're all regulated by the Department of Insurance. So they can only raise their rates a certain percentage. So people don't understand.
Yeah, and that's the problem for what I understand.
Yes. So they haven't been able to raise their rates. So what are they doing? They're leaving the state, or they're not writing as many policies.
Right.
What does that do? That leaves you to go fend somewhere else. And that's that non-admitted market or the excess and surplus. And that's where you're seeing those 5X.
Now, the problem with being a non-admitted insurance carrier is that since you're not regulated, the consumer can't make a complaint to the state. What's the real difference there?
You know what? There's a number of different nuances, but really what it is the higher risk you are, that's when you need to go to those admitted carriers.
So they're more expensive to buy.
Yes, they're more expensive. They're taking on a higher risk. And a higher risk, just like a loan, if you have great credit, you get a really low interest rate. If you have poor credit, you're going to get a higher interest rate.
Gotcha.
And these admitted carriers have their standards or their guidelines. And if you don't fit those guidelines, then they're not going to be able to write the insurance. And that's going to take you to this, what we call secondary market, excess and surplus. You know, those are the things. And unfortunately, because of the size of the HOAs being so large, not a lot of insurance companies want to insure those larger communities. You deal with large communities, you have 100, 200 units, those could be $100 million. So all in one concentrated area, one insurance company is insuring that whole thing. And that's the challenge, especially if you look at the LA fires.
Jeez.
If you lose the whole thing, that's $100 million per HOA.
Yeah.
So it's so they're trying to mitigate their risk overall.
Okay. Well, let's just touch on real quick why everything went to 20% and beyond last year. And I'm assuming from what I've read, it was the fires up in Northern California, Champlain Towers, which brought a new kind of
regulation.
And then the hurricanes that hit Florida and the Gulf Coast last year. And then, of course, now the fires in LA. But is that correct? Is that what was the big whammy?
Yeah, I think it started with
those expenses.
Yeah,
and also the collapse of the bond market. Yes. Wasn't that a problem for the insurance carriers?
And interest rates and
interest rates. Yeah.
So I mean, it started with the campfires up in Northern California, right? The way most insurance companies work is they're going to take a certain amount of risk. Let's say they take the first $50 million. We have a $200 million property. After that, they're going to buy reinsurance. So it's kind of like splitting the risk with another party.
Sure, Swiss Re.
Right, exactly. Or Lloyd's of London, a bunch of these companies. So what happened with the Northern California fires is they had to pay out. And these
the reinsurance companies had to pay out.
And they're not used to paying out. They're used to collecting because there's never claims that are that large.
Gotcha.
So that was one of the catalysts that started these reinsurance companies. So the cost of reinsurance went up.
Gotcha.
So when a company wants to provide insurance for large HOAs, they insure, let's say, the first 50 million, and they have to go get reinsurance for that other 150. That cost went way up. So when you package that together and you give it to the client, now it's much higher.
Fascinating.
So, and most insurance companies aren't just in California, right? They're national or global. So they're going to spread that risk out over all of their insureds. So to your point, what happened in Florida, I mean, we've seen some very catastrophic flooding in areas that have never happened before. And that goes back to the severity of these losses are bigger. I mean,
huge,
yeah, huge. You used to go back and you would look in history to determine what to calculate the risk going forward.
Right, and the reason being is the cost.
Yes.
Because there have been hurricanes when I was a little kid, a long time ago. I remember some of them reaching up into New Jersey and Pennsylvania where I lived. Big, bad hurricanes, but it's the cost that's different, right? Am I right? Or
yeah, no, I mean, the cost...
Katrina was the costliest so far, I think, at 80 billion or 100 billion. No, I think it was 120 billion, Katrina.
Yeah. So we definitely have some headwinds, and I think we wanted to talk about too of like what do we do now?
Yeah. What the HOAs do? What does a board of directors do? You know, you come make presentations to boards of directors and say, hey, I'm sorry, your insurance is going up 20% this year.
I'd be happy to present those.
Or you live in a fire zone and your insurance is going from $40,000 a year to $400,000 a year, and those are the killers. And I've heard about a number of those.
Yeah. We just had an example, from 90,000 to 700,000.
Right. Yeah. How many are there of those extraordinary increases? Is there any way to put a guess on that?
You know what? From our experience, I can at least give you our experience. Okay. I would say maybe 10, 15% are in that extreme catastrophic scenario, right? A lot of them are in that 2 to 4x increase, right? So you're going from 40,000 maybe to 80 or 120. But those are if they're, in their extreme high fire risk area. Right. The big challenge, and you're dealing with maintenance, is the age of these properties. Right. The carriers are getting more particular about what they want to insure. They don't want to insure older properties or ones that have Zinsco panels or these things that have been recalled, right? So they're tightening their guidelines.
Gotcha.
So it's taking,
So of California's 52,000 associations, maybe as many as 3,000, 4,000, 5,000 are in these catastrophic fire zones. And they've had their insurance increased crazy.
Yes.
Okay. That's interesting.
Yeah, so
That's interesting.
It has, and with everything just continuing to go up in cost, and now you have more variables like, the California Fair Plan that's now being tested with, not having enough money to cover the claims that are being presented.
And like you said, I read that they're going to now, the Fair Plan is now going to go grab money from the insurance carriers, which they should have just insured the consumer directly, which is crazy because the California Insurance Commissioner wouldn't allow State Farm to raise their rates significantly enough. They would allow like 6%, I think I read, as they were asking for 30% increase in rates because of the fires and the payouts.
Yep.
So is California coming to its senses? Is the insurance commissioner going to allow the major state farms, these companies raise their rates so they can cover their costs?
We're hopeful. We're hopeful, but if you look at what's just happened in the last week or two, right? State Farm did put in for a large increase, and it wasn't approved.
Was not approved.
Was not approved. Also, too, with asking for the money for the Fair Plan. So the way that Fair Plan works, right? All those carriers pay into this fund that's supposed to help when there's a catastrophic event. Now, when there's not enough money, they go back to the well to the people that are insuring it.
They're going to pay anyway.
Right. And who's going to end up paying for that?
The consumer.
Right. Exactly. So it's this merry-go-round of things. So I'm on a number of different committees and task force that are trying to get the word to government to say, hey, this needs to change, right? Because a lot of it, the Department of Insurance, and you look at the commissioner of what they're doing, They're trying to help the consumer, which is a great, noble effort. But if you run out all the insurance companies that are going to actually do the insuring, how great of a job is that?
And there's no other state doing this, which is another issue. I mean, why?
Yeah.
So, okay, well, we got to get beyond. We got to get beyond
those
big picture problems. So the problems are going to stay with us.
Yes.
And so I guess my main question today
is what can HOAs do? Right?
What's going to happen this year?
Yeah.
So I'm a board of directors. I'm a manager. I have 10 communities. And budget season is, August, September.
Mm-hmm.
And are they prepared for it, do you think? Another increase of 20%? Are they ready? Do you have any idea what's going to happen this year?
Yeah, that's a great point. I think we're still going to see, we're not out of the water by any means.
So 20% again?
At least, right?
Okay.
I would say. And really what HOAs need to be doing is knowing that this is going to continue to be the largest line item on their budget. And they need to attack it that way.
Mm-hmm.
Are you increasing dues?
Mm-hmm.
Right? Are you looking at, all the aspects of your budget? Because just saying, oh, we're going to put our head in the sand and hope that it's not.
Yeah.
That hope is gone now. You need to have some reality. You touched on what your business has been impacted by insurance.
Mm-hmm.
And that's interesting to me. When before you were saying that the amount of work that HOAs are doing is less because they're spending that money on insurance.
Exactly.
Deferred maintenance.
Well, when they get hit with the budget increase like that, they get nervous and they stop spending money September, October, November.
Yeah.
And then the boards meet less November, December, Thanksgiving, Christmas.
And then,
it
turn it back
sort of goes back to normal January, February in terms of the operating budgets.
Yeah.
But I think this year could be different because of all the things we're discussing. So if I'm a board of directors, if I'm a manager and I'm advising my board of directors today, February, March, April, what do I tell them? What would you like them to say to their boards for this coming budget preparation season?
Bring in your professionals, especially property management, property managers, right? You're not an expert in everything. So call up your broker, make sure they're on the line. Have them meet, not when the proposal's there.
Yeah.
Meet 3 months before. Say, hey, let your professional explain that to the board.
Yes, to get to work.
And bring them in, because it is a complex situation. And really understanding that working with a broker that's going to communicate, right? We hear of stories of like, well, we haven't even heard from them. They just sent us the renewal at the last minute, and it is what it is.
Yeah.
If that's acceptable, great.
Yeah.
We don't want to operate that way. We want to operate more in a boutique feel and have a relationship with the board as well as the property manager. Because I think in the past the property manager has been able to kind of be the go-between. But this is getting so complex now that trying to play a game of telephone from what you're hearing about the insurance to get to the board, it's better to just let it go right to the horse's mouth.
Great. And so get to work early.
Get to work early and be realistic.
Yeah.
Right.
There's going to be another big increase.
Right. So look at your budget and plan for that.
Big increase. Unfortunately,
yeah.
For everybody too. I mean, for my business, the increases are significant and every year now.
Yeah.
So let's talk about the connection for a minute. Let's talk about the connection between Fannie Mae, Freddie Mac, FHA financing, the governing documents requiring insurance to get the financing.
Yes.
And that's somewhat of a complex conversation too, I think.
Yeah.
And especially when you bring to light what's going on with Fannie Mae, Freddie Mac, and they now have a blacklist of, I think recently it was 4,500 communities. So my question to you, Cory, would be, what do you see out there with respect, what's your intersection with the financing aspect, with the lending, with managers saying, hey, I have to have this insurance so we can keep our FHA?
Yeah, and that's been a big challenge. We know somewhere between 75 and 80% of all transactions inside an HOA are usually done with some type of FHA or government thing. So you have a large percentage of transactions that are going through that. The issue becomes
conventional financing
versus conventional financing, right? The issue becomes when they can't get enough insurance. So FHA and these other government things, they have minimum requirements, right? They wanted 100% insured, and the deductible is not supposed to be more than 5% of the overall. So when you don't meet those guidelines, they're not going to lend.
Right.
You might have
right.
in your CC&Rs that you should maintain a certain amount of insurance.
Exactly.
But there's two sides of the coin. Okay, let's say the market will actually provide you full insurance. It might not be at an affordable rate. So which part do you not adhere to?
Insurance,
bankrupt the HOA,
yeah,
or comply with the governing documents. What we've seen is these HOAs are not able to get full limits, and it's knocking them out of FHA approval. And if you can't sell a property, how much is it worth?
Yeah.
So that's the challenge. And we have a number of HOAs that are experiencing that. And we have realtors that are calling us and saying, hey, we need this insurance. Mike, this, they don't have this insurance. And the boards are having to make tough decisions overall. So it's challenging. So the solution to that is we're hopeful that those FHA requirements will be relaxed, but they haven't changed in quite a few years.
No, I'm not confident they will be relaxed.
Right, exactly. So, I mean, they're talking about privatizing FHA. I don't know. There's a bunch of
that would be a way off.
Right there, yeah. So, I mean, it is right. It goes back to what do you do today, and that's the challenge right now with the market. So
yeah, so that's another big challenge.
Yes.
Yep.
Luckily, we don't see too many HOAs that are experiencing that. It's a relatively small percentage.
Yeah. And
we're hopeful that it's a short period until we're able to find some other options.
Now, one of the other options, a workaround, if you will, an attorney called me and said, hey, our insurance, we're in a fire zone. Our insurance was $40,000 a year. It's going to $600,000. We're going to change the governing documents, and we're going to make it so that the homeowners are responsible for the exterior of the home's common elements, which is different than before when the HOA was responsible for the exterior common area elements. Are you seeing much of that changing of the governing documents, changing the common areas?
Yeah, no, we definitely suggest looking at your governing documents, especially the insurance portion, to understand that. Work with your legal counsel. Some HOAs are able to do that. It's based off of the original construction of that HOA.
Yeah.
Right. If they're able to be separated, now you're having each individual unit owner take on more responsibility. And really, what you're doing is you're transferring some of the risk.
Exactly.
But it's better to transfer it from, instead of trying to insure $100 million, you're insuring a smaller amount, and then each individual unit owner can do that. But that takes getting a vote, getting that. But it's
legal fees.
Yeah. Well, it's usually motivating when you go from, hey, you're going to be assessed $6,000 annual assessment, or we can look to adjust the governing documents.
Gotcha.
So that's when usually the community will act, because they're faced with a substantial increase.
So are you seeing much of that?
Few and far between, especially here in San Diego and even in Orange County. It's just the original construction type is challenging. If you're on top of each other, it kind of knocks you out. I don't want to say legally. I mean, I'm not an attorney, but from what we see, the parties that have success with altering their documents have those kind of
like duplexes, that are conjoined, townhomes,
where there's some of that stuff that was built in the 80s, where it's just one adjoining wall that you can do, so you can separate, because basically what you're doing is saying the HOA is no longer responsible for that.
Exactly.
But the challenge we have that we haven't seen is what happens if there's a major loss.
Right. Are there any other workarounds other than changing the documents? Any other workarounds of transferring the risk to the homeowner and off of the HOA?
Yeah, I mean, there's a lot of HOAs that look to expand the rights or the abilities of the HOA to consider different options, not just full coverage. And full coverage is kind of a general term, but it's really giving them more options, because some CC&Rs were written many years ago when insurance was relatively inexpensive. So it said must include this, everything, right? So adjusting some of those to give the board some options, or we call levers you can move, will help to, again, definition of insurance is a transfer of risk, transfer a little more risk to each individual unit owner versus having it pooled together and trying to find a large policy to cover that.
let's go back to normal times
Yeah.
when insurance company losses were, from what I've read, 50% hurricanes, big catastrophic tornadoes, things like that. And then the other 50%, 35 to 50% were water losses, water intrusion, roof leaks, water leaks, all that water, which was related to maintenance, which is why we're interested in insurance, right? Because we fix water leaks.
Exactly.
And we do preventive maintenance. And our objective with doing that is to make sure we reduce the number of water leaks so managers have less calls, because the calls always happen Sunday night. Or Saturday night, right? And so is that still about the same? I mean, is there still a focus from the industry on water intrusion?
Well, it's still
on roof leaks, on maintenance. I know you mentioned the electric panels. There's a lot of things an HOA can do to reduce its risk, primarily by maintenance, and I'd love to get your thoughts on that.
I think what's happening now, even with the current market, is the carriers are getting more particular, right? There's certain guidelines that they have, and they're just enforcing those. So, right, insurance claim, a water loss is not meant to supersede deferred maintenance, right? If you have a roof that isn't maintained, and there's damage from that, that being covered is in question, right? Because the source or the reason for that was due to deferred maintenance. So you were talking that some of the HOAs aren't doing that maintenance. That's going to cause more pain, right? Because you're going to have more water losses, right? We have, up in Orange County, we have a lot of HOAs that, the piping, they get pinhole leaks, right? They've some of them completely repiped, but just your general run-of-the-mill deferred maintenance is causing more claims to be filed overall. So yes, if the HOA can be proactive, get a maintenance program in place, and manage that stuff, their rates are going to be low, because your rates are going to be affected by the amount that you insure and the amount that the insurance company pays out. So the more they pay out, the higher your risk profile is going to be.
And I've seen some HOAs, or I've heard of some HOAs taking a larger deductible, not submitting claims, covering the cost in-house before they actually go ahead and submit a claim for that very reason, I'm assuming.
Yep. No, I mean, but back in the day, when we're talking the good old days, right? It was $5,000 or $10,000.
When was that?
I don't know. A while ago, too. It's in the rearview mirror, but it's been. It was at $5,000 or $10,000. Now we see $25,000, $50,000, or even $100,000.
That they'll cover themselves?
Yeah. So the deductible, the HOA is not going to get involved until that point. Construction costs have gone through the roof. Last number I saw, it's $17,000 to replace a bathroom. Right. And that's nothing.
Replace the deck.
Right. And whenever there's a loss in a condo, it's not one unit.
Yeah.
It's 2 or 3 or 4.
Right.
So that balloons quickly.
Right.
So again, transfer of risk, you're transferring a little less risk to the HOA and making that individual unit owner be responsible for more, because you don't want to use the HOA's insurance policy as kind of like a safety net.
Yeah.
It's in place for catastrophic events that take place.
So you would advise HOAs that even though their insurance is increasing 20% a year here, to continue to focus on preventing water leaks in their communities, reducing trips and falls on their sidewalks, electrical exposure, things like that.
Yeah, we all call those loss control items.
Loss control.
Right. Yeah. So really when most insurance companies take over a property, they're going to go do an inspection. And they're going to map out what issues are with the property, right? So yes, addressing those is important, right? And avoiding, claims, right? Slip and fall, these other issues. Yes, that's a good insurance policy for the HOA to do that. Just like managing claims. If there's a small claim, don't run and file a claim to the insurance company. Find out what the issue is and get a dollar amount for it. If you have a $25,000 deductible and it's only a $20,000 loss, don't file an insurance claim.
Exactly.
So that before the mindset was to just, we have insurance, just file it.
Right.
You got to manage that, and that's what the property management companies can do, is help manage that, so that the insurance companies aren't going to negatively impact the HOA at renewal. So
going back to the insurance carrier.
yes.
I've read that some of them are flying drones over communities to check out the roofs and check out the other common areas and actually see what's going on. How common is that? Have you heard of that?
We've seen that. We've seen, I've had a client that told me that they were told that they need to get on a Zoom call, turn their camera on, and walk around the house, the interior of the house and the exterior of the house.
Really?
There's definitely drone stuff that they're using third parties that can go out and survey multiple areas. We've heard a neighbor that got non-renewed for algae on their roof. So now they have before it was too expensive to try to drill down that far. But now with this modern technology, AI, all these, I mean, pretty soon, right, Google Earth is just going to go over the top and AI is going to just give you a report of like, here's all the policies you need to cancel. I mean, it's
crazy. I want to see the first insurance robot.
Oh, yes. Yeah.
I see it coming.
Oh, yeah, yeah.
Yeah, insurance robots.
But I don't think
walking all around.
I think they'll just be, I mean, there's a roofing vendor that I know of, and they'll do a complete inspection of your roof for $99, and they do it from a drone. And they're down to a hairline crack in a tile.
Wow.
So if they can do that, these insurance companies, they're now trying to mitigate their risk.
Right.
So these are all things that they're putting in place to try to do that.
Right.
And I think it's going to continue, especially if rates continue to go up. They're instead of using a chainsaw, they're using a scalpel to try to determine where the risk is.
Right.
So it's going to get. And we've seen it more and more and more. I mean, it hasn't hit the HOA space as much, but we see with a lot of individual homeowners, they get a report and it's got pictures and this, and it's like, whoa, it feels like Big Brother's watching you. And it's like, hey, what are you doing about this?
But if you're desperate for a policy, or a quote even, you're going to give them just about whatever they ask for, including, the bathroom.
Yes, you have to, and the requirements are becoming higher. That bar is becoming higher of that. So we have a lot of clients like, oh, can we find something better? It's like right now the grass isn't always greener, right? Make sure you understand what you're getting yourself into. We just had a client that they wanted to switch to this thing. We got them this new policy, and then that carrier came back with a bunch of subjectives that they had to fill, and it ended up costing them money as well. So, looking at things from a holistic view is important, not just the dollars and cents.
Right.
So,
do you attend any carrier conferences, insurance industry conferences where the carriers are there talking about best practices?
You know what? There's a number of different ways. We're part of CAI, we're part of CACM, we're part of ECHO. Those are trade organizations in our space. In regards to carriers, we work with a lot of different wholesalers. And, we do attend some of those. A lot of those are Zoom right now where we get them. Plus, they all provide, kind of updates overall. But them kind of getting together to give us the best practices. It's more of we all know what needs to be done.
Yeah.
It's just a matter of can you accomplish it. And right now, I mean, the biggest challenge for HOAs is it's the dollar amount, right? These HOAs can't weather these large increases.
Yeah.
Right? They're getting their HOA dues are going up.
Yeah.
And it's not competitive to sell, the property if that goes from $300 to $600 and you're trying to compete with the next HOA that hasn't had that issue. Yeah. It's challenging.
Well, plus all the time it takes to communicate to the community, because normally when you throw out a special assessment, the board gets recalled.
Yes, yeah, right. Legal, town halls, all those things that go on.
And it's stressful. All that noise.
And stress for the managers.
Yeah.
It's really, and they're not charging enough to deal with all that stuff, right? Yeah. It's super challenging. So.
Yep. Do you see any relief on the horizon?
You know what? I'm always an optimistic person.
Yeah.
I think we have a lot of people that are trying to affect change. Mm-hmm. We're meeting with congressmen. We're doing. We're trying to get the word to that, because the problem is that we see is the HOA never comes up in conversation.
Right.
It's always about the individual homeowner, right? And that's fine. But ultimately, where do all those homeowners live? They live in an HOA.
Most, yeah.
So we're trying to, how do we get that conversation up to those, you said 52, I've heard 55,000, whatever, to all those, about those HOAs of like, these are the ones that are going to be impacted because it's the cost for the master policy that's going to impact every single one of these that live in there by their HOA dues, because who pays for the insurance policy? The unit owners. And that gets passed through to their HOA dues. So, you know, we're still trying to get that message through, and we're not going to stop until it's communicated. So.
Yeah, it's so that's another way of saying I don't see any relief on the horizon.
I hope there's some change. Let's put it that way.
Yeah. Well, in California, I mean, is there any expectation that the California Insurance Commissioner is going to come to a senses and allow the insurance carriers to charge what they need to charge to stay?
We were hopeful. But just what happened last week, where they said they were going to approve these rates and then they didn't. It's mixed messages. So it's hard. I mean,
and that's going to be a problem.
I don't want to say that the LA fires just amplified what's going on. So even before that, we had a crisis. Now we have this on top of it. And how many people are going to be affected by that? And where is the where's people's thought process going to be after they go through this? If it takes 2 years for them to get back in their house, it's there's some change that needs to happen. I'm way down here on that, but
I was surprised that Governor Newsom waived all the environmental requirements to fast track the permitting process. That was interesting.
I heard a commercial from Karen Bass, and she's like, we have this great center where everyone can come and you can meet with the 12 agencies that you need in order to rebuild your property. Exactly. Cool. Why are there 12 agencies that we have to go through? So even if everything is streamlined, that's a systemic issue. Like, you're not going to get back to where you need to go if you have to go through 12 agencies to get where you need to go.
And you know what that is? That is, all of these poor homeowners are going to now see what home builders have to go through when they have to try to build a new home community or apartment community here in California, which costs twice as much as it costs anywhere else in the country because of CEQA, California Environmental Quality Act, which can shut down projects, which costs developers 3 years. It takes a developer 3 years to get a permit to build here in the state. So now homeowners, LA, who are really, they don't need to learn that lesson, but they're going to learn it. It's a bad lesson.
I know. I just saw on somewhere online that there's a company that's they're winding themselves up to help with that process, help get through the permitting process, help do these things, because it's an area that you don't want to be proficient at, and you have no reason to be until you get thrown into it.
And it doubles the cost of housing. That's what it does.
And a lot of the insurance policies, a lot of things we see weren't insured to the right value initially.
Exactly.
So now you're only getting X, but it's going to cost 2X to rebuild. So where does that delta come from? So I mean, it's going to be interesting to see what happens. We already hear, in Maui, you heard, people coming in and trying to buy properties and do these things. There's going to be a lot of people that don't want to rebuild, or can't rebuild. How is that all going to play out from a mental health perspective?
And the other question is, how long?
It's
is it going to be 1 year, 2 years, 3 years, 10 years to rebuild most of those homes?
Camp Fire, I think it was 16,000 homes built. 8 years later, we were just looking this up, 3,500 homes have only been replaced 8 years later. So even if we're a fraction of that, Maui's a great example too, right? It's been a year and a half. They're barely starting to rebuild right now. So think of all those families. I think of myself like, wait, my grocery store, my school, my business, everything is gone. Am I going to stick around and wait 3, 5, 6 years to rebuild while my kids get older?
No,
or am I going to move my life somewhere else in order to actually have some type of livelihood? So it's catastrophic.
It's a catastrophe. Is what it is. It's so sad.
So I hope our leaders step up and really kind of shine at this time. And I'm hopeful.
Now, one last question, and this has nothing to do with insurance brokers, because you guys work your buns off. But for insurance carriers, I've always said that in the end, they never really lose money and it's a great business.
Yeah.
Is that true?
That's a good question.
In the end, I'm talking over a long period of time.
I think, it's a complex way that a lot of these carriers are set up. I would maybe agree with that to a certain extent. It's kind of like the house always wins.
Yeah.
I know they're putting out a lot of risk, and I think a lot of people don't.
They have so much money.
Right, but they don't understand the risk that's put on the line.
Yeah.
Look at what's going to happen with the LA fires, right? They're everything that they have in reserves is going to be wiped out, right?
And I guess, well, the question to you is, could some of those smaller, medium-sized carriers go out of business?
I mean, it's potential.
Have you seen that?
If you look at Florida kind of as an example, right? Like these insurance companies have to be solvent, right? They have to have a certain amount of money, right, to be able to pay out the claims, and if they can't, then they're supposed to get taken over by the state.
By the state, yeah.
But I think there's been enough mitigation done where that's not going to necessarily be the case. But I think there's going to have to be some government intervention, right?
Yeah.
Because they're not going to be able to weather that much. And really, it's you're talking the individual homeowner. When the insurance company says, we already paid out everything, we did our job, we paid the full limit of the policy.
Yeah.
Are you going to expect them to pay even more because it took to rebuild more? Like that's I think where that gray area is going to come.
Yeah.
And do they get some government assistance? I don't know. We have a couple people in the HOA space, managers, that have completely lost their home, and there's one that's kind of chronicling his journey, and it's really interesting, right? It goes from total catastrophe to like, hey, we just got approval to get everything removed, right? So there's an emotional journey that all these people are going through too, that a lot of people don't take into consideration. Money's fine, but where do you sleep? What do you do? Like how do you carry on with your life? So there's going to be a big toll on a lot of people.
And from what I heard last year at the insurance conference, CAI's Insurance and Legal Conference, 1/2 of the property in the United States is basically uninsured. They call it naked.
Yeah.
And so I thought that was pretty interesting too.
Well, yeah, a lot of, if they own their own property and they don't need to carry insurance, right?
Don't have it, yeah.
They're self-insuring from that risk protection. Now HOAs don't have that.
HOAs have to. So that leads me to my very last question, I promise, which is, for the HOA board members and managers that are viewing us here, is there any one last piece of advice you would give them going into this year? And I think you've already given some great advice, but any one last piece of advice?
Get comfortable with your insurance policy. Make sure you know it. Like we have a lot of clients that are now calling and going,
read it?
Yeah, read it, right? Or review it. Do a review. Ask for a review with your current, so you understand it. Because I think a lot of people just assume, oh yeah, we're good. It's kind of like people have car insurance. Oh, I have full coverage. I'm good. Well, you have this deductible. You have this. Understand
exclusions.
You
want to read the exclusions.
Yeah. So understand that. Not just assume. Oh, we got a renewal, so it's good. Get intimate with the policy language so you understand it. And if you don't understand it, then get with your broker or your agent and make sure that you understand it.
And I think boards should understand their policies.
They should. And we have a lot of new board members that come on, and there's a lot of a lack of information. I think we have board members that don't really know what's going on, and it's not like car insurance. People just assume that it's just like any other insurance. It's a different animal. So I would say educate yourself on that policy.
So for all those new board members, read your documents.
Yes.
Read your reserve study.
Yep.
Read your insurance documents.
Yep. And then send us a copy and we'll look at it.
And then good luck and God bless. Well, Cory, thank you so much.
Yes.
A lot of great information.
Yes, thank you. I appreciate your time always.
Today.
Yes.
Appreciate it.
Thank you.
And thank you, everybody, and stay safe.